Okay, we have your weekly market update here for you from January 20th to 26th. It'll be presented by myself, Robert Duncan, followed by Preston Hawley, and then finished up by Ryan Bentall. We'll start with some equity, convertible, and debt financing, some of the recent news in that. Takeover loans have decreased a lot with the downturn. Wall Street has billions of dollars in loans that were made to finance the corporate buyout boom, especially last year, and now they're unable to sell them. For example, Morgan Stanley is currently struggling with a $1.2 billion loan that they made with some other banks backing a pharmaceutical company that just lost their major client. Banks are usually willing to take on these risks because the payout is much higher than normal loans, but they also run the risk of closing in tougher economic times, which makes it more difficult to sell these loans to investors, which is currently happening this week. A little bit from the merger markets. Tyco and Johnson Control are merging. Johnson Control is buying out Tyco for $32 billion, and they're moving their legal headquarters to Ireland, which is known as a corporate inversion, which is actually pretty controversial right now. They're combining the heating and air conditioning systems, fire protection, and security technology of those two companies respectively to form an Internet of Things, quote unquote. Another merger that's happening right now is Huntington Bancshares and First Merit. They'll combine for about $3.4 billion in revenues annually. Together they form the largest bank in Ohio. And Goldman Sachs was a financial advisor for Huntington Bancshares, while Sandler O'Neill and Partners served as the financial advisor for First Merit. Huntington continues to grow in Ohio and is expected to continue to expand into new markets in both Chicago and Wisconsin. Okay, we'll just give you a brief overview of the economic conditions around the world and in the United States. China is continuing to slow down. Its economy is evolving broadly, moving a little bit away from manufacturing and catching up with the Western world. But its imports and exports are slowing a lot more than previously thought. As well, there's lower prices for energy and other commodities because of the low price of oil. However, this puts strain on fuel exporters while supporting household demand and lowering business energy costs. As well, the prospect of an increase in U.S. policy interest rates has led to tighter external financial conditions, declining capital flows, and further currency depreciations.
As far as regulatory, accounting, or tax developments goes, the SEC just came out with a new regulation that companies are allowed to test file in preparation for crowdfunding offerings. Before, they would just have to go in front of the SEC and propose their crowdfunding offerings and see if it would go through or not. But now, starting May 16, 2016, there will be a preparation for which they'll be able to submit practice forms that will be reviewed by the regulation and see if it will go through. And so it kind of gives a test run to see if it will go through correctly. And these filings will not be reviewed by the SEC nor available to the public, but will let the companies know if they need to change anything furthering ready for their offering. And there are many articles going on now that are arguing whether the Federal Reserve have made a policy error with their rate hikes, or if they're going to continue and go with what they actually said they're going to do and raise the rates 4 different times in 2016. With their change in December, it has tightened lending, and many investors say that it is inducing a recession, that if the Fed follows through with their 4 rate hikes during 2016, the downturn will continue to grow. And the error in policy is hurting the economy and placing burden on investors. The ultimate goal of the investors, the analysts, and critics is that the Fed will realize the error in their policy and make the corrections to ensure that we do not fall into the exact same crisis that the Fed was trying to avoid. As far as investment banking firms go, there are several things in the news. Most importantly, that AMBAC is suing JP Morgan because of past and future mortgage-backed securities for around $3.3 billion. Now, that's a large sum of money, but right now, through the lawsuit, they've been able to settle with Ambac Financial Group for $995 million. And this is coming just on the heels of JP Morgan getting out of a lawsuit from Lehman Brothers for allegedly siphoning billions of dollars before Lehman Brothers collapsed. And JP Morgan has said that neither of these lawsuits, even though they've been for several billion dollars, is going to affect their earnings, but that Ambac will have will increase their revenue and their earnings for this year substantially because of this lawsuit.
So now a quick summary of the global markets. Around the globe, those involved in the market have pulled back from risky assets. People are a lot more hesitant to invest their money in riskier and riskier items, even though the return may be high. And so they're taking their money out of those risky assets, and they're more willingly putting them in things that are more secure. Although the economic fluctuations have been frequent, a lot of the experts don't believe that they're going to tip us over the edge. They believe that we're on the fence right now of a downside economic scenario, as they put it. But at this time, they don't think that these fluctuations that have been happening in the global market are enough to push us over the fence into that recession or depression. But they also say that there is a high possibility of a downside event within the next 3 years. And so we need to be looking out for that in the global market and seeing whether or not that is going to happen within the next few years, and be very wary of that. The effect of this possible downside event in the next 3 years would definitely cause a sharp decline in the risky asset prices. Obviously, if there's a recession, people are going to want to put their money into things that are more secure, and so the demand for the risky asset prices would largely decreasing the price as well, more so than we've actually already seen in the recent times. Also, the figure on the right shows us just how different economies throughout the world are doing. It shows the discounted interest rate and that they're diverging, which shows the diverging economic conditions of each one of those countries and how they're differing. And so we have the Eurozone, we have the UK, we have the United States, we have Japan, and it just shows such a great variety of which ones are growing. The United States and the UK look like they're pretty similar, and as far as their growth, the UK looks a little bit more sporadic and volatile. And then we have Japan, which looks like it's slowly been decreasing from a fraction of a percent down to about 0. And then we have the Eurozone as a whole, their discounted interest rate has been below 0 for the last 24 months. Now to move on to the LBO and hedge fund markets. Warren Equity Partners has teamed up with Multifuels LP to build a midstream platform. Although oil prices are plunging, the nation continues to need oil and natural gas, obviously. And so Multifuels LP is contributing an existing natural gas pipeline that they already have. And Warren Equity is funding that operation, contributing $20 million. And so that is to try and increase the supply that we have right now, and they are very confident in their ability to be successful in this endeavor, although the oil prices continue to plunge. Also, on that same subject, in the LBO and hedge fund markets, something really interesting is that automated hedge funds have made hundreds of millions of dollars in January due to near ideal market conditions and computer-driven systems that aid in trading. And so the decline in oil, the stock prices and currencies around the world have actually created this perfect world, perfect scenario that allows computer-driven trading strategies to have success. And so hedge funds actually lost money last year, as you can see from the graph on the right-hand side, and they've made quite the strong rebound in the beginning portion of 2016. If we look just at the far right side of the graph, the rapid increase in just the first month of 2016 gives a lot of hope for these hedge fund managers and those who have their money in hedge funds. Most of the hedge funds actually have rebounded to have about 7.5%
increase just in this first month. And so that's something that's really exciting for anyone who has their money in hedge funds or those hedge fund managers who honestly had a very, very disappointing 2015, really helping them to feel more confident and hopefully instill more confidence into our economy right now, which is much needed with all of this speculation of a possible recession near. And so that is our presentation, our weekly market update for this last week, January 20th to the 26th. I hope you enjoyed it. I really appreciate you listening and giving us this chance to show you what we've learned from the local economies as well as the global economies and things that are happening in the investment banking industry.